We are not just entering another trading week, we are entering a compression point, a moment where multiple structural forces are converging at the same time: monetary policy tension, AI acceleration, geopolitical instability, currency regime shifts, and capital rotation across continents. And when these forces align, markets don't just move, they reprice. Let's start from where investors actually are right now. Wall Street just reopened after a partial government shutdown. The S&P 500 and the Dow have closed -4 out of the last 5 weeks. The Nasdaq? 5 consecutive red weeks. That's not panic. But it's not stability either. It's distribution. It's hesitation. Because investors are no longer asking, is AI bullish? They are asking something much deeper. Is AI accelerating growth faster than the system can absorb it? Or is it destabilizing capital structures before policymakers can adjust? And that distinction changes everything. For the last 2 years, artificial intelligence was treated like a growth narrative. It was simple: higher productivity, higher margins, higher valuations. But now the conversation has evolved. AI is no longer just a tech story. It's an infrastructure story. It's a labor story. It's a defense story. It's a geopolitical story. And most importantly, it's a capital allocation story. Let's talk about India, because something significant is happening there. Over 100 million weekly active users on generative AI platforms, second only to the United States. That's not incremental adoption. That's demographic scale penetration. When AI tools reach that kind of scale, you move beyond novelty. You enter productivity reconfiguration. Students use it for research. Developers use it for code acceleration. Small businesses use it for automation. Call centers integrate it into workflows. Legal teams integrate it into drafting. And suddenly, the labor cost curve begins to shift. And here's the thing most people miss. The faster AI adoption spreads in emerging economies, the faster the global labor arbitrage model changes. For decades, outsourcing meant cheaper human labor. Now outsourcing increasingly means cheaper AI-augmented labor, and that has direct implications for U.S. services inflation, for wage growth, for middle-class job displacement risk, for political reaction. Now zoom into the supply chain side. Everyone talks about GPUs, but the real bottleneck right now? High bandwidth memory, advanced memory chips, scarce, extremely expensive. AI systems require massive memory bandwidth to train and deploy large models efficiently. Without memory, GPUs become underutilized, which means cost per compute rises, which means return on CapEx declines. And here is the second layer: energy. Former tech executives have testified that scaling next-generation AI infrastructure could require tens of gigawatts of incremental power. To put that in perspective, one nuclear power plant produces roughly 1 gigawatt. So we are talking about dozens of nuclear plants just to power AI. Now ask yourself, what happens to energy demand forecasts? What happens to natural gas, to uranium, to copper, to grid infrastructure spending? AI is not just code. It's electricity, it's steel, it's copper, it's semiconductors. It's physical capital intensity on a scale we haven't seen since early internet infrastructure build-out. And this is where China enters the equation. While Western markets were focused on earnings, Chinese AI firms strategically launched upgrades during peak Lunar New Year traffic. Alibaba committing over $50 billion in AI infrastructure spending, DeepSeek pushing new versions with competitive coding capabilities. And here's the critical divergence. The US is racing toward AGI, artificial general intelligence dominance. China is racing toward diffusion, embedding AI directly into robotics, logistics, and manufacturing. One strategy aims for peak intelligence, the other aims for maximum distribution. Different philosophies, same objective: digital supremacy. And let's be very clear, AI is dual use, civilian and military, which makes this not just a corporate race, but a national security race. There are ongoing negotiations between AI firms and the U.S. Department of Defense. Some companies are hesitant. Others are actively pursuing contracts. Others are pursuing contracts to develop voice-controlled drone swarms capable of autonomous coordination. Voice commands translated into multi-drone battlefield orchestration. This is not science fiction. This is procurement. And when AI becomes embedded in defense capability, valuation models change, risk premiums change, capital flow changes. Now layer on monetary policy. While all of this is happening, the Federal Reserve is walking a tightrope. This week we get private payroll data, FOMC minutes, industrial production, and most importantly, PCE inflation, the Fed's preferred inflation gauge. After the last print, expectations for rate cuts were pushed further out. Probabilities still below 50%. Why? Because growth is not collapsing. GDP remains resilient. The labor market remains tight. Private AI investment remains strong. And that creates a paradox. If the Fed cuts too early, it risks reigniting inflation. If it holds too long, it risks tightening into geopolitical fragility. And the geopolitical layer right now is not trivial. Iranian forces conduct exercises in the Strait of Hormuz, through which roughly 20% of global oil supply flows. A U.S. carrier group moves toward the region. Oil volatility risk rises. Now let's talk about the dollar. Fund managers are more pessimistic on the dollar than any time since 2012. For decades, the dollar served as the ultimate hedge. Now, that correlation is breaking down. Why? Because the U.S. market is now heavily concentrated in AI-driven mega-cap tech. If the U.S. market is no longer the default safety zone, global asset allocation shifts. Europe becomes more attractive. Emerging markets become more attractive. Treasury yields hover near 4%. Gold remains historically elevated. Bitcoin stabilizes. Capital is reallocating. Markets are differentiating between enablers and casualties. AI infrastructure outperforming. Workflow automation under pressure. This is selective capital discrimination. 2026 is a regime transition. Monetary policy is constrained by fiscal expansion. AI productivity by infrastructure, geopolitics by energy. That combination produces instability. This is not a market for narrative chasing. It is a market for structural awareness. Risk management survives. The architecture of power is being rewritten in real time. Capital markets are adjusting to a new architecture of power. Narrative alpha disappears. Risk management survives. Stay analytical. Stay diversified. I'll see you in the next one.